In March of the year 2000, there was one company on earth worth more than any other, worth more than Microsoft, worth more than General Electric, worth more than every oil giant, every bank, every car maker on the planet, the single most valuable publicly traded company in the world. It wasn't a household name. It didn't make a phone or a car or a soft drink. It made the boxes that run the internet, routers and switches, the plumbing nobody thinks about until it stops working. And on one single day, the 27th of March, 2000, its stock closed at about $80 a share. And the people who owned it had every right on God's green earth to believe they were holding the future itself. Here's the part that should stop you cold. They were right about the company, and they still waited 25 years to break even. Let me tell you the story because the story is a fundamental lesson on investing. Now, quick orientation before we go any further, especially if this is your first time here. I'm not a trader. I want to be very clear about that because most people that talk about stocks on the internet want you to believe they were born with some kind of gift. I don't have a gift. What I have is an MBA in finance from Pepperdine. I used to hold a Series 7. I work as a financial advisor. And I came up with this idea. It was like a stubborn curiosity about whether a machine or a system could find things in the market that human being would never be able to see, at least on a daily basis. So I actually built one myself. It's called BuzzPulse. It reads social chatter, volume, sentiment, options flow, and about a dozen other signals across nearly 57,000 stocks. And it hunts for the rare mornings when a lot of independent signals all point at the same name at the same time. I run it in public. I do a show on YouTube every morning, and every morning it finds something or it doesn't. And I tell you what it found, and then the market opens and we find out together whether it was right. Some mornings it hits and some mornings it misses. The record is on the table on my dashboard. The link is in the description. I'm Ken Carpenter. This is Invest AI Savvy, where AI powers smart investing. Welcome to the Sunday Stack. Welcome to Sunday, May 31st, 2026. The company in our story is Cisco Systems. Now, please, before I tell you anything, do your own research and consult a licensed professional before you make any trades. Now, let's get to Cisco. In the late 1990s, the internet was arriving all at once and somebody had to build the pipes. If a business wanted to get online, it bought Cisco's routers and switches. If a phone company wanted to move data, it bought Cisco. The entire world was wiring itself up, and Cisco was the company selling the wire. The stock did exactly what you'd expect. From its public debut in 1990, it compounded at roughly 100% a year for a decade. And in just the 2 years heading into the spring of 2000, it ran almost 600% more on top of that. On the 27th of March, 2000, Cisco passed Microsoft to become the most valuable publicly traded company in the world at a value north of $500 billion. Serious people in print in major newspaper predicted it would become the first company in history to be worth $1 trillion. Now, here's the number I want you to hold on to. At that peak, Cisco was trading at a price to earnings ratio of about 200. For every single dollar the company actually earned, investors were paying $200 for the privilege of owning that dollar. That's not a company price. That's a lottery ticket priced like it's a sure thing. And then the internet bubble broke. And now here's the reason the story stops being the one you would expect. Because Cisco didn't go bankrupt. There was no fraud. There was no accounting scandal. The pipes didn't stop selling. People didn't suddenly stop using the internet. The opposite, obviously. The internet ate the entire world over the next 20 years, exactly the way the internet believers and prophets said it would. Now, what happened was simpler and in a way much scarier. The premium just evaporated around Cisco. By the bottom, in the autumn of 2002, Cisco stock had fallen nearly 90% from about $80 down to 10. And the business underneath the stock, it kept growing. Cisco's revenue was about $19 billion in the year 2000. 20 years later, it was more than 50 billion. The company more than doubled its size. It got bigger, stronger, more profitable. It bought other companies. It moved into new markets. It survived every single thing the next 2 decades threw at it. The stock didn't care. Year after year after year, anyone who bought at that March 2000 peak was simply underwater. Not because they picked a bad company, they picked a great company. They just paid a price the great company had to spend a quarter of a century slowly growing into. And here's the kicker, the part that's so recent, you might have missed it. This past December of 2025, Cisco's stock finally closed at a brand new record, $80.25 a share, topping that March 2000 peak for the very first time. 25 years just to get back to even. So here's why I'm telling you this on a Sunday morning in 2026, because I watched this exact story play out last week on my own dashboard in real time. Last Wednesday, the single loudest name in the entire market was Micron, the memory chip company, MU. The day before, it had jumped 19% in one session and crossed a $1 trillion market value for the very first time. And when I checked the social data, the engagement around Micron was at an all-time high. Mentions were running 300% above their normal daily average. Social dominance at a 52-week high. The entire internet, all at once, was screaming about one memory chip company. It was the loudest reading the system had logged on any name all year, and the whole market was leaning toward it. Now, I want to be careful here because I'm not telling you Micron is going to crash. I don't know that, and nobody knows that. So let me do the thing that most people skip and actually put the two companies side by side at their two big moments. Start with Cisco at the top in 2000. At its peak, Cisco was earning only about 36 cents a share, and investors were paying roughly $200 a share for every single dollar of those earnings. And that thin little stream of profit was about to slow down, not speed up. You were paying the richest price on earth for growth that had already begun to fade. Now, if you look at Micron last week, and here's where it gets interesting because the actual numbers, Micron is almost the exact opposite of Cisco. Micron is not earning pennies. Over the last year, it earned more than $21 a share. And in its most recent quarter alone, it earned over $12, blowing right past what the analysts had expected. And the growth isn't fading, it's accelerating. Revenue is running about 60% higher than it was a year ago, and analysts are now modeling earnings north of $100 a share inside of 2 years. And for all that, you're paying only about 40 times earnings, a small fraction of the 200 EPS that Cisco commanded in the year 2000. So on the surface, this looks like the easiest call in the world. Real earnings, explosive growth, a far cheaper price. So you're probably asking, where's the trap? Now, here's the trap, and it's a different trap than what Cisco was looking at. Micron makes memory chips, and memory chips are the most violently cyclical business in all of technology. The profits don't just grow, they boom, and then they bust. And Micron's own history proves it. At a past earnings peak, this very stock traded at under 3 times earnings, and people called it cheap right before those profits collapsed. And the very same analysts modeling $100 a share next year are already penciling in a decline the year after that. So here's the question. Last week, with the whole market screaming about Micron at a record high, were buyers paying top dollar for the good times right when the good times were peaking? Cisco's trap was an insane price on real but slowing earnings. Micron's trap, if it is one, is a reasonable looking price on earnings that might be sitting right at the top of their cycle. And that's the whole lesson in both cases. A great company and a great price are two completely different things. They don't always live in the same year, and sometimes they don't even live in the same decade. The company can be everything the believers say it is, and the price you pay at the loudest possible moment can still be the number that takes years or an entire cycle to grow back into. That's the one lesson I want you to carry out of this episode. When a name is suddenly everywhere, when the whole internet is screaming about it at once, and when it just crossed a number nobody thought it would cross, that's not your signal to chase it. That's your signal to ask one quiet question. Am I buying a great company, or am I buying a great company at the exact kind of price that took the last generation 25 years to recover from? The machine I built can find you the name. It can show you the moment the whole internet is pointing at one thing at the same time. That's why it's genuinely good to look at. And last week, it pointed straight at Micron, the same way it would have pointed straight at Cisco in 2000 if my system had existed back then. But the machine can't tell you that the price is fair. No machine can. That part is on you, and that's the most important part. And it's the most important part that almost everybody skips. So don't let the noise do your thinking for you. Know the story before you read the signal. The loudest name in the room is almost never the cheapest one, and the most exciting price you'll ever see is usually the most expensive one. I'm Ken Carpenter. This is Invest AI Savvy, and that's the way it is.